What's up, everyone, and welcome to the Daily Macro Update for Monday, November 17th. Taking a look at the macro data for today. Still not getting much because of the the government shutdown caused a lot of the macro data to be delayed, and we're going to be getting a lot of that later this week on Thursday and Friday. But, taking a look at the market reaction today, we're getting more of a follow through from what we saw on Friday, which is that the stock market is having a little bit more of resistance here. Some things more than others, which we'll get into. But what's interesting is that we're actually starting to see a little bit more of positive activity from some of the leading economic indicators, such as the New York Fed Manufacturing Index, which saw its strongest rise in about a year. And as we know, the manufacturing sector is one of the best leading economic indicators of the aggregate economy. And so when taking a look at this, it had a pretty decent acceleration, and it has had over the past 6 months, more positive readings than negative. This is important because if we go back over the past, let's just go back 5 years, you can see that, heading into 2021, in the middle of 2021, this was all positive, and then it started to go, into negative territory in 2022. And then since 2022, it's really been in a huge recession, really, in the manufacturing sector. And then just recently, we've been having a nice little stride of positive readings, a little bit of a negative blip there in September. But you can see that the rate of change here has gone from deeply negative to less negative to now mostly positive. And so that is a positive rate of change, which is definitely something to take note of. And it's something that is also maintaining higher levels in the current GDP Nowcast. When taking a look at the Atlanta Fed's GDP Nowcast for the update from today, November 17th, we can see that the current estimate is at 4.1% for the year of 2025, updated for the Q4 estimate. And so, seeing that it's way up there, you have to ask yourself, if growth isn't slowing down, in fact, it's actually looking like it's going to be even stronger than last year, then as well as at the same time, you have inflation expectations remaining well above 2%, which is 3% through November. Why would the Fed cut rates? And it's for this reason why, when we take a look at the target rate probabilities for the December Fed meeting on December 10th, in just a few short weeks here, for the first time, and we covered this last night on the Sunday Macro Wrap-Up, but for the first time, we saw a flip in the probabilities leaning more towards a pause in December than a 25 basis point cut. At the timing of this recording, right now there's a 55% chance that they pause versus a 45% chance that they cut by 25 basis points. This is a huge change from the past 5 weeks because just, 5 weeks ago, not even just 1 month ago, on October 17th, the chances of a 25 basis point cut was 94%, and now it's 45%. And then the chances of a pause was 0%. In fact, a month ago, we saw that there was actually a 6% chance of a 50 basis point cut. So we went from 94, 25 cut to, and a 6%, 50 basis point cut. Now a total flip to now a 55% chance of a pause. Now that's a very big swing in just one short month. And it's because of this macro dilemma here where you have high growth and higher inflation, stickier inflation, and a rebounding growth. Now, that's not what the market wants to see. It wants to see more of a Goldilocks type of soft landing where you still have strong growth. So the strong growth component is great. They'll take that. But they need to see inflation come down as well. And so that's really what we're seeing here. And what a lot of economists, and this doesn't really matter in terms of strategic positioning and us, owning things in our portfolios, but a lot of the PhDs have been talking about how this massive acceleration in GDP is mostly being propped up by the massive amount of deficit spending by the government. And then at the same time, because of all this stimulus that's being applied to the markets by the government, it's also keeping inflation up. So they're getting one half of the equation right because of the rise of inflation. And so that's a pretty interesting thing. The only time really when you're going to get a decent amount of interest rate cuts is if you have a large drop off in growth and inflation, which typically happens when the market is not doing well. And so part of the reason why we're seeing a sell-off right now is that, if the Fed's not going to cut rates and we also have growth and inflation rising, well, there could even be a chance that the bond market hikes for the Fed. So even if the Fed doesn't raise the Fed funds rate, the bond market, bond yields can actually start to rise, which we're actually seeing a reversal of that right now, while at the same time, we're getting some funding stress in the financial markets. All of this combined is causing volatility to have a little bit of a spike here. And right now, it looks like the market just closed. And so with volatility closing above 20 at 22.3, that is not what you really want to see if you're somebody who is all in on risk on assets. Now, the biggest sign of this type of, tighter liquidity environment is Bitcoin. So Bitcoin has been doing well on the basis that, liquidity was about to be flooded into the market. Now, that has been happening with the government, but if the government is also trying to reduce deficits at the same time from here heading into 2026 because of rollover risk, right? All of those shorter duration bills that it keeps on printing in order to fund the deficit, that can't last forever. And Scott Bessent over at the Treasury Department, he knows this, and they've said that they're going to have to start reducing that. And so this signal from Bitcoin, which Bitcoin is a very highly sensitive asset to liquidity, you can just look at this and be like, yep, credit spreads are starting to widen a little bit. You're getting the spread in SOFR versus IORB starting to widen as well. And so liquidity is 100% tightening. And so because of this, you're seeing a shift into the dollar, gold, as well as more defensive types of sectors like healthcare, which as of right now, healthcare is the best trending sector of the S&P 500 right now. If we take a look at XLV here, there are bull markets that are happening, ladies and gentlemen. So just because in things that everyone talks about on TV and YouTubers talk about all the time, which is stocks and Bitcoin, there are still bull markets out there. You just have to broaden your horizons and have more of a macro outlook. And this is why post-pandemic, including macro analysis into your process is paramount. Don't just be team technical analysis. Don't just be team fundamental analysis. Both are incredibly important, but why not have macro as well in there? Use TA, use fundamental analysis, use macro, use all three of them. It's a three-legged tripod with your investing process in order to tackle the markets here post-pandemic. You got to pay attention to everything. And so don't just lean one way or the other. Think of like a highly skilled contractor who can do a lot of different jobs at the same time. He has a very deep toolbox. Add macro as one of your tools. So healthcare, utilities might end up gaining some strength here. Industrials is starting to lose trend. This is even looking like it's gonna go bearish here, so I wouldn't even include industrials in that bullish list. Healthcare, utilities, as well as energy are the three most bullish trends. Biotech, yes, Richard Lozano. Biotech has been, one of the better ones as well. So 100%. Yeah, if we look at a chart of IBB, IBB is the iShares Biotech ETF. That's a bullish trend right there. Good call out there, Richard or Ricardo. Ricardo, I'm waiting for you to join the 6-week challenge, brother. Where are you? We're waiting for you in there. Come on, let's go. Hi, can you show the index ranges for XLV? Sure. We'll get to that in a moment here. But what's interesting is that, you're starting to see bond yields stop going down. Now, bond yields are still in a bearish trend, but they're barely in a bearish trend, and they've gotten less bearish, which is pretty interesting. And one of the concepts that we talked about last night is a very important one. Let me see if I can actually bring up the X post that I was referring to. Or actually, we can just take a look at, let's just take a look at this article here from November 7th from the Apollo Academy, Signs of Stress in Money Markets. So this is one of their chief economists talking about how the reduction of the Fed balance sheet, so the QT that they already did, as well as the heavy T-bill issuance by the government, has been putting upward pressure on spreads in money markets. And they cite, the T-bill growth issuance here, which is definitely something that, we want to make sure that we're taking a look at. But what they highlight here, and what I want everyone here to start to track on their own TradingView charts, is the spread or the difference between the secured overnight financing rate, SOFR, minus the interest rate on reserve balances, IORB. Now you can pull this up on TradingView here. And the reason why this is so important is because it's showing you the funding stress in action. And so if you go back all the way to 2021, you can see that we haven't had a spike like this in quite some time. And this is what's showing that liquidity is tightening. It's the reason why Bitcoin has been doing so poorly. And so essentially, the main thing to take away from this is that QT, or the stopping of QT, is not inherently bullish by itself. Because a lot of people thought that ending QT meant we're going to have QE come back, which is not the case at all. That would normally be true if the Fed was stopping QT and then went back to aggressive buying of the same type of bonds that it was doing beforehand, which is the longer term treasuries, like 10-year bond yield, or 10-year bonds, 20-year bonds, 30-year bonds, as well as mortgage-backed securities. But they're not doing that at all, right? So the type of assets that the Fed is buying right now, the type of assets that the Fed is buying right now in order to maintain the same type of level in assets, is short duration bills. And they're letting a lot of their longer term debt still roll off, and then they're taking that principal and then reinvesting that. What that means is that for a lot of the higher risk mortgage-backed securities that they want off their balance sheet, they've already announced this, all of that risk is being dumped back into the private markets or in the public markets. So they're still offloading all that risk and duration to the financial markets overall. So an analogy can be, if you're swimming in a pool and, you had some heavy weights on and you were struggling to float there. Somebody came and was like, "Oh, let me, you're in 10 feet of water. Let me just lower it to 8 feet of water." But it's like you still can't touch the bottom, and you still have the heavy weights on. So how does that really help? And that's really what we're seeing here. Right? So this is not quantitative easing. This is essentially just addressing the plumbing problem that had a Band-Aid on it from the reverse repo facility over the past 3 years being drained. That was putting a huge Band-Aid on it, but now that Band-Aid is gone. And so now we're getting exposure to what's really been going on over the past 3 years, but it's been covered up. And so the reason why this spread is so important is that SOFR is the market price banks pay to borrow cash overnight, and the IORB is what the Fed pays banks to hold with cash at the Fed. So in normal conditions, the SOFR stays below IRB because no bank should pay more in the market than what it can earn risk-free at the Fed. And so when the SOFR rises above the IRB, that means banks want cash more than they want the Fed's interest rate, which means reserves are getting tighter in the system, and this causes funding markets to come under stress. And so this ending of QT is more of a signal that there's scarce amount of reserves, not that they're about to flood the market with liquidity. And so that is the biggest risk here. And that's the reason why Bitcoin has been acting the way that it has, because it's noticing this large spike in funding stress. So, in terms of the why things are happening, it's not as important as being positioned strategically in the things that are going to make you money, right? So it is important to understand why and how all these things are working. But even if you were just paying attention to trend analysis, you can still get ahead of these things, before there's a huge break in the markets. But, all these things are causing volatility to rise, and, it's getting to that point here in 2026 where there has to be some type of reconciliation with the way that the government has been funding itself with these massive wartime deficits. We have the debt to GDP over 100%, which hasn't been that way since World War II. You have the majority of the country, the bottom, 50% of households, not having a good time. Really, the only people that are having a good time is the top 10% of Americans, which, hey, they may have worked hard to get there. God bless them. But still, when it comes to the majority of the country, a lot of them are not having a great time. And it's that K-shaped economy that continues to form here. And that's really what the pandemic did. If you want to boil down the biggest disruption that the pandemic did, the supply chains, all that stuff. But the biggest thing is that it essentially accelerated the inflation rate by about 15 years. And so it smushed all that inflation and condensed it in a very short amount of time to where now the spread between rich and poor is just blown out. So when that happens, you're going to have some problems here. And I'm sure it's going to cause some social issues as well, which, we don't cover that here on this channel unless it helps us make some money in the markets, which might sound harsh, but what really can we do besides vote and manage our money ourselves, right? And there's plenty of other people smarter than me that do political commentary. We'll just focus on the markets here. But all this matters to us and our portfolios is that the market is shifting more into a defensive stance, and the best performing assets are defensive sectors, mainly healthcare, utilities as well. Gold is performing again. Silver is starting to perform again. And so this is really just a more intense version of that stagflationary environment, but in a tighter market. And so what you're witnessing right now is the bond market tightening for the Fed. The Fed doesn't even have to raise rates. They can just stay where they're at, and the bond market will tighten it for them. Now, is that a situation that they want to be in? No, this is a nightmare scenario for the Fed. This is a situation that they wish they were not in. And that's why a lot of people have been comparing this to the 70s stagflationary environment. A little bit different for reasons why we're in it, obviously, but there are some analogies, similarities. But this is not a situation that the Fed is happy that they're in. And this is a very tight balancing act to do, and it's going to take precision. It can be done. It is possible. But think of the market right now is that the Fed and the government are trying to perform, a very high risk brain surgery, and they can't mess up at all. There is absolutely no room for error. Now, up until this point, the Fed was showing confidence with the government that they were able to perform this balancing act. But the longer they go on this tightrope, the harder it's going to be. So 2026 is going to end up being very interesting. We're also heading into a midterm election. Now, I'm not somebody who deals with averages, or any of those other things, but statistically, midterm years have been a very painful time for the market. 2022. I can look up this tweet right here. And again, this is only for entertainment. This is not for making any type of decisions. It's just very interesting to look at this type of data. But let me see if I can bring it up here 1 second. I liked this on my Twitter a little while ago. But I think this data goes all the way back to 1967, I believe. Let me see if I can find it here. No. It was about a month ago, so it might be too far back for me to scroll live. Should have just prepared it before I came up here. But the main point of the study was going all the way back from 2024 all the way back to it was either 1961 or 1967. The average return was -1%, while the other years were around 10 to 12% for different years in the markets for the S&P 500. So yeah, midterm years typically are not the best, but of course there are times where it has done well. I think during the one of the Clinton midterms, as well as one of the Reagan years, I believe it actually did perform very well. So it's not like every single midterm year is going to be bad. It's just the average there, what's typical. But it is interesting how that's coming in line with how we are literally entering into 2026 with clear signs that there's funding stress. But yeah, so that's pretty much what I'm seeing here right now. We can take a look at some of the highlights here. We already talked about Bitcoin, S&P 500 having a bit of a dip. Let me see something here. This is getting close to going neutral in the model. I don't think it is just yet. Small caps did go bearish. So when we take a look at something like IWM, which is the ETF for the Russell 2000, small cap ETF, that went bearish on the 13th, which was last Thursday. And then since then, it's down another 300 points. So when small caps are doing poorly and bearish, when Bitcoin and the cryptocurrency markets are bearish, that's definitely a shift, right? Google doesn't care. Take a look at Google. This thing is continuing to rally, still near all-time highs, having a little bit of a slowdown in performance, but still in a very clear bullish trend. The big one that went to bearish trend was discretionary. consumer discretionary. So that's pretty interesting there. But what's also interesting is that staples, consumer staples, is also in a bearish trend, in a deeper bearish trend. So it's propping up our XLP to XLY ETF ratio. But we're clearly going into more of a risk-off type of environment. All right, let's go ahead and get into some questions here. Appreciate everyone for joining. Let's see what kind of questions you all have here. Oh, I never showed the ranges for healthcare. Apologies on that. It's near the top end of the trading range still, though. Right now, the low end of the trading range for healthcare is 148 to 147. So, around 148. Now, if you want our trading range model indicator on TradingView for yourself to use on demand, then all you have to do is join our 6-week challenge, which is free. All you have to do is book a call with me, and we can go over the details to see if it's something that you have time for. I know all of our lives are busy, especially during the holidays here, but I guarantee you it's worth it. So yeah, just go to the link in the description below. For those that are on my Instagram or TikTok, it's just the link that's in my bio there. Is silver still bullish? Yes, it is. It is bullish. Don't really like how it formed this this lower high here. And then it's also kind of slumping right now. On lower volume, that is. So that's good to see a lower volume on a red day. I did buy some gold and silver on Friday. Wasn't buying any more today, though, because we're starting to see some volatility pop here. Remember, when it's like full-blown recession, the only thing that does well is bonds and the dollar. Gold still sells off when you have a liquidity event. Because when funds are getting margin called, how do they raise cash? They sell all their gold. It's the most liquid asset that they have. So when you have a rush to safety, like true oh crap safety, gold ends up going down pretty quickly. The only reason why gold has been doing well is because this has gone into more of an inflation hedge, not necessarily a deflationary event. Does that make sense? All right, let's go ahead and go over to the TikTok comments here. Appreciate everyone for the likes and the shares. Let me just scroll through any type of questions that you have. I have to squint my eyes because the text is so small on my screen here. I have to scroll with my one hand up. We are in a recession, no question. Work in management at a large multinational industry manufacturer. Wow, really? Industrial manufacturing? Yeah. I mean, it's still, even though we've had a little bit of a rebound in manufacturing, it's still very low compared to pre-pandemic levels. So, yeah, manufacturing has definitely been in a recession for a few years now. The internal consensus is that Q1 and Q2 will be ugly. Wow, that's good information. W for the commenters giving us some inside information here. Make sure you stay anonymous, though, so you don't get flagged. What are your thoughts on bio stocks like KRRO? We can look it up real quick. I don't know what it is. Let's see. Pharmaceutical. This does not look great. I don't know what this company is. $57 million market cap. Get out of here. That's way too small. Yeah, don't even look at this. I'm going to change this ticker so that nobody looks that up. Nah, anything under like $2 billion market cap, you're trying to gamble on penny stocks. What do you think about MUD and MU? Micron definitely is in a bullish trend. MUD, not sure what this is. Did I type it in wrong? Yeah, Micron is another one that's in bullish trend here. Yep. So if this has a dip, if you were just buying this on any red day, you're up big. Good call out there. Good call out. At what level would you consider the S&P to be in a bearish trend? I mean, it really depends, you know, because if it has a pretty big red day from here on higher volume and accelerating volatility, then it'll probably go bearish at that point. We'll see though. We'll see what happens if it happens this week. It's definitely inching that way. Lost a lot of strength today. So I would not be surprised if it does go bearish trend at some point this week. I'll let you guys know though. You'll first notice because the background of the bookshelf will be a different color. But it may have gone neutral today, just now. It may have gone neutral. I don't think so. I think it is still remaining bullish. Yeah, I'd say it's still bullish, actually. Let me see what the ranges are for the SPY. Yeah, so it's right at the low of the trading range. Still higher than average volume. One week volume is higher than 1 month volume. So that is an acceleration in volume on lower prices. Not really a great thing to see. And we also have 30-day historical volatility above 90-day. Yeah. This may have just broken trend, its bullish trend here, but we'll see. I might want to give it one more day. What are your thoughts on the Fed's approach to this liquidity crisis? I mean, really, the Fed is losing control. That's the thing. They're losing control right now, and so it's not a great thing to see that. Do you think there's a good chance that the top is in for the SPY? I don't know. Possibly. Tops and bottoms are never confirmed unless you're looking in hindsight. So anybody who ever says the top is in or the bottom is in on something, and they're just saying that, they're completely making it up. Complete liar. That should be a red flag. If you follow anyone and they say the top is in a serious manner, sometimes I joke, but yeah, that should be a red flag because they're just trying to guess to get views. And if they are motivated by views instead of giving you guys the information that will actually help you navigate markets, then I would just question their motives at that point. You won't get that on this channel, though. People are like, why don't you do price predictions? Why don't you talk about when things are going to happen? Because those things don't matter. They really don't. Just own bullish trends until they go bearish. What level of skill would a person need to join your course? It's not a course, it's a community. And is it worth it for someone that knows nothing to join? Yeah, I mean, we assume that you are coming into our community with zero knowledge on macro. That's what our training modules are for. But yeah, I mean, as long as you have a willingness to actually learn this stuff and not just, try and get by without diving in deep to what this all means, then yeah, you'll do fine. Yeah, just book a call with me, Reese. Link in the bio there. What's the bullish scenario and what's your take on probability? Thanks for the great content. Yeah, no, great question. I like the cat picture. We got two cats ourselves, my wife and I. But what is the probability of a bullish scenario? I mean, you can still have, I mean, there's still, the S&P 500 has been in a bullish trend for quite some time. So we are still in a bullish scenario. We're just starting to see risks start to prop up now. Now, if you mean what's the probability of us doing a soft landing? I mean, historically speaking, it's less likely than a hard landing. You know, it really just depends. What you really want to see is growth continue to, or organic growth continue to go up. You need to see the debt to GDP ratio start to come down. You need to see inflation start to come down more, closer to the 2% target. Those are really the signs of a soft landing. You know, that way the Fed can continue to slowly lower interest rates and maybe come to a neutral rate that might be, maybe around 2.75%, 3% area, you know? But anything that takes us off that course, the market is not going to like, which is what we're starting to see right now. Good question, though. I don't have a percentage for you. Do you think real estate prices will also crash due to liquidity? I'm not sure. Because I don't know if, unless something crazy happens where you have a bunch of selling and people need to get out of their mortgages. But if people can hold their mortgages, I don't think prices will come down like crazy. Now that depends on the area that you're in, because nationally you can say prices might come down, but locally in your area they might actually go up. So when it comes to real estate questions for me, I can only talk on a national scale. But when you are wondering about prices, you really need to talk to either a broker that you trust or you need to look up some local data that you're in, because it's just so different from where you go. Like for where I'm at here in South Florida, the rate of prices have come down a little bit, but they're still near, pandemic highs. And I don't think that they're going to come down. I just think the rate at which they were going up came to a stop. When Powell gets replaced with the new Fed chair, ignoring inflation, aggressively cutting rates to appease Trump, yeah, probably. But yeah, I mean, you risk inflation coming back, so I don't know how that's going to help, especially with inflation, how bad it's at right now. Hi, Johnny. What are your thoughts on WM for a long term? I don't know. I don't really look at things like long term unless they just continuously remain in bullish trend. But no, I mean, this is bearish trend, so I'm not even buying this. It's not even on the list of consideration. The only time I will hold something long term is if it just maintains bullish trend for a long time. Like for example, with gold, that has pretty much maintained a bullish trend since 2022. And our model, since it just isn't going bearish on it, then I'll just keep owning it and I'll keep buying dips on it. If it ends up being a long time where it's more than a year, great. If not, that's fine too. Can Celsius come back bullish anytime soon? I don't know. Anytime you guys ask me a question on what price level will this go to or what time frame or blah, 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 I will always answer you, I don't know. Now, if your question is phrased in what type of macro scenario would this thing continue to do well, or in what type of macro scenario would this, it's bearish right now, could reverse and go back to bullish, I'll definitely, elaborate on that answer. But if you're asking me when things are going to happen, I don't know. I can definitely look at the rate of change right now with Celsius and tell you I don't even want to touch that with a 10-foot pole right now. Is VIG still a good hold? Again, is it bullish or bearish? Vanguard Appreciation Fund. It's lost a lot of trend strength. It's pretty much been at the same price that it's been since September. No, there's way better things to own. In your opinion, what will be the highly anticipated move from the Fed until long-term bond bull buying cycle QE? They're probably just going to maintain a higher Fed funds rate. The thing is that I don't think they have a highly anticipated next move unless something breaks. They're trying to be as boring as possible for as long as possible, because that's what calms the markets down. The reason why they do the press conferences is so that they can calm markets down and sell the idea that they are an authority and that they can influence the markets, when really they don't. The Fed is pretty much, useless except for making our lives miserable. They're a banking cartel. They can legally produce counterfeit dollars. And they're technically a private entity. You and I would get arrested and thrown in jail for life for doing that. But the Fed is mandated to do it by Congress. Insane stuff. Thoughts on hard assets like gold and silver? Both are bullish trend. Thoughts on OKLO? Bearish trend. All right, we're going to go ahead and end it there. We went way over, actually, so that's all right. But I appreciate everyone for joining. We go live every single day here. I know I was like 5 minutes late today, so I appreciate your patience. But we go live every single day, Monday through Thursday at 3:45 p.m. to catch the close of the market. We typically only go until about like 4:10, 4:15, but we went a little bit longer today. But yeah, we go live every single day for the close, Monday through Thursday, and then we're off Friday and Saturday. And then on Sunday, we do what's called our Sunday macro wrap-up, which is at 8 p.m. Eastern time, every single Sunday evening, where we get ready for the week. We look at, the major trends that were developing the previous week, how that is playing in the major trends in the business cycle. So if you guys haven't already, I'm trying to grow the YouTube channel as well. I don't know. I'm not a marketing person. I don't know how to make viral videos. I don't know how to sell stuff. I'm just like a nerd who talks about this stuff online. So I'm trying to grow the YouTube channel. If anyone knows how to grow a YouTube channel, hit me up maybe. But I'm just going to keep doing what I'm doing. And I think eventually people will catch on. But I appreciate everyone for joining. Have a great rest of your Monday. And we will catch you in tomorrow's daily macro update. Bye, everyone.